Well, despite the volatility and ructions that have characterized the global financial arena over the past 6 months, the outlook for medium-term returns from most asset classes doesn't look that great. Joining us to discuss valuations, and they've done a lot of work on it, is Peter Brook, Head of Macro Strategy Investments at the Old Mutual Investment Group. Thanks, Peter, for coming, going in front of your camera there at Old Mutual and having a chat with us. Let's just unpack things perhaps from a broader perspective. You're not terribly excited about the possibility or the opportunities, and remembering we're talking macro, big picture, of earnings and profits, and as a result, share prices rising by too much from their current levels in the immediate period.
That's right, Alec. I'm coming to the end of another month. It's another great return from equities, and every time this happens, it takes away returns from the future. So if we do our valuation work, multiples are getting higher and higher, and there's less and less value, which leaves us with a conundrum, because at the moment we've got valuations or price looking quite expensive, but you've still got very strong momentum in the equity market. And I think it starts to create a dangerous environment where your risk-reward ratio has deteriorated.
It was interesting reading through your research numbers and a reminder of how low interest rates really are in parts of the world, well, outside of Africa. Just take us through a few of those, because there's some quite frightening figures, including, I think, in Denmark, where it's negative now.
That's right. I mean, we've got a fundamental issue in terms of interest or carry, particularly in real terms. So even in South Africa, where you're getting 4.5%, 5% from the bank, because inflation is 6%, you're going backwards in real terms. So all over the world, we've got a situation of very low rates and very high liquidity. And that liquidity is being forced to find a home. And at the moment, the home that it's finding is in the equity market. And if we look at our JSE, now the forward price earnings ratio of the overall market is now up at 14.5 times. And that's the highest level we've seen since the 1990s, so about 97, 98. And there is a lot less value left in our equity market.
Remind us what happened in 1997, 98.
Well, you know the answer, Alec. It was a very bad year for markets. I think we've just got to be careful, because if you look at the historic PE of the financial and industrial index, it actually hit the level that it's at today. It hit that level in 1993, which was and that's a high level, but actually you had another 4 years of bull market. The difference between then and now, though, was the earnings base of the market was very low back then. And I think the potential for earnings to grow as fast is much reduced. So it is fundamentally more expensive today than it was back in 93, 94.
Another head scratcher has got to be the way that the governments continue to print money, particularly in the north and the rich north, and particularly the Western Hemisphere, and that the government debt levels are growing continuously. Where does this all end?
Well, in the short term, it's not ending in inflation. I don't know if you noticed the European inflation numbers out today, pretty low. So there isn't, the long-term expectation is this type of money printing should result in inflation. But the truth is we're sitting in a deflationary world at the moment. So the money printing is actually just sustaining growth at current levels, but the money flows into markets. And that's where the risk is do we get a bubble? So I mentioned earlier that the Findi PE was very high. Another time that it was as high as this was in 1968. And 1968 obviously went on to double after that because it was a bubble. And I think this pool of money hunting for returns does create a potential liquidity risk or speculative risk. And that's really what I think is keeping people in the equity market and is keeping equity markets so strong.
So is it keeping you there as well?
terms of our philosophy, we see it in terms of theme and price, and we were overweight equity. As a result of the higher multiples and the reduced valuation, we have sold some shares on behalf of our clients, and I just think that's prudent in terms of managing the risk. But because we build multi-asset class solutions, we're still going to maintain an amount of equity that's appropriate for the end customer outcome. And it's really a case of, are you moving from overweight to underweight within that space? And we were long, and we are lightening into strength at the moment.